Welcome to another episode of CRE Fast 5. I'm Carly Iacono, and tonight we're talking about the battle over caffeine. Personal preference aside, which coffee chain is coming out ahead in the US? What are the new brands to watch? We'll cover all of this along with the typical net lease deal structures for the leading companies. Let's go. First, some industry statistics. Americans drink 646 million cups of coffee per day, which equates to about 3 cups per average coffee drinker. During the pandemic, drive-through and app ordering rose 30%, and 41% of consumers tried a new type of coffee. Now, obviously, work from home habits are still impacting local coffee shops. 48% of Americans have already returned to their local coffee shop with regularity, so that is improving. In fact, more Americans choose coffee each day than any other beverage, including soda and even tap water. The two main players in the space will come as no surprise, Starbucks and Dunkin' Donuts. Starbucks had 8,940 company-operated and about 6,300 licensed stores in the United States in 2020, with more than 32,000 locations globally. Starbucks is publicly traded and has an investment-grade credit rating of BBB+. The Starbucks customer base is very loyal, with many going an average of 16 times per month. Now, the revamped rewards program that they rolled out in September 2020 has been a big driver of sales growth and has added to this loyalty. And it's something that I discussed in more detail on the CRE Fast 5 episode covering the gamification of retail a few months back. Check it out if you missed that episode. From an investing standpoint, Starbucks is attractive because all of their leases are corporately guaranteed. Their standard base term is 10 years, but be aware that many of their leases contain an early termination option in year 5. So if this is the case, you would only be getting 5 years of guaranteed rent. Most Starbucks leases also have roof and structural responsibilities on the landlord, so they are not typically absolute net. The GLA is usually 1,500 to 2,000 square feet, and they are prioritizing drive-through locations moving forward. Despite the shorter lease terms, Starbucks will trade at a premium due to the strong credit and rent increases every 5 years found in many of their leases. If you are evaluating a Starbucks investment, be sure to inquire about the early termination option and pay attention to the age of the roof and parking lot, as they will likely be your responsibility. Now let's move on to the second key tenant, Dunkin' Donuts. Dunkin' was taken private last December and is now owned by Inspire Brands, which is the holding company of private equity firm Roark Capital, which also owns other high-profile brands like Arby's, Buffalo Wild Wings, Sonic, etc. The transaction closed at a 20% premium over Dunkin' Brands' stock price as of October 23, 2020. One change that Inspire intends to make that will affect investors is that they are separating the Dunkin' and Baskin-Robbins brands into 2 distinct brands. Now, some of these legacy locations are co-branded with the 2 concepts, but that doesn't sound like that's going to be the strategy moving forward. Dunkin' currently has about 8,500 restaurants in 41 states across the US and another 3,200 locations internationally. The majority of their locations are franchised, so if you're looking at Dunkin' as a potential net lease investment, you want to drill down into the strength of the franchisee and make every effort to get store sales so you can evaluate the rent to sales ratio. If your lease isn't as strong or your lease guarantee, the unit level fundamentals become even more important in the deal. Typical Dunkin' leases run 15 to 20 years on the base term with rent increases of 8 to 10% every 5 years. Average DLA is 2,200 square feet. And more often than not, Dunkin' Donuts is true triple net or ground lease, so the landlord responsibility should be minimal to none. Although Starbucks and Dunkin' have an overwhelming amount of market share, there are new coffee concepts and brands taking a substantial bite out of the apple. Dutch Brothers Coffees is one to watch. They have 325 locations in 7 states and are actively expanding in the Western US. Typical lease terms are pretty standard at 15 years on the base term and 10% increases every 5 years, with a big emphasis on the drive-through instead of the sit-down cafe. Another one to watch is the Human Bean, with over 200 locations open or under development in 23 states. This is a drive-through only concept that is franchise-driven and focused on higher-end quality ingredients. The last one for today to watch is Biggby Coffee, which has 243 stores with another 103 locations under development. The Biggby tagline is specialty coffee for middle America. The price point is more in line with Dunkin' than Starbucks, but the specialty beverage options are plentiful with a very strong focus on sweet drinks. Single-tenant coffee concepts remain very in demand from an investment standpoint, and as consumers have shown, the away-from-home coffee consumption habits of Americans go well beyond the morning commute and have become a part of everyday life, no matter where that day takes us. That was CRE Fast 5. I'm Carly Iacono. I'll see you next week.